Well, there's only one person who has successfully done this for 3 decades, and his name is Jim Simmons, and he did this with 3 hedge funds. So the first interesting part of his story is that when Jim Simmons actually started up his first hedge fund, it was more about a mathematical curiosity than it was about attempting to get rich, although that is obviously a very big carrot. And even if he did not enter into the investment world, he actually would have gone down in history as a respected mathematician. He had actually won many prestigious mathematical awards. So now he had recruited all his mathematician mates and also former NSA Russian code-breaking friends from when he used to do that back in the day. And he started getting to work. They trialed all sorts of random probabilistic models and market-beating theories and then put them to the test in small scales and in different markets just to do a lot of trial and error. And eventually, they found that some things did work and other things did not work. But do you know something that's actually very interesting? In the end of the day, out of all the trades combined, they were only profitable for 50.75% of their trades. So almost 51%. It's actually pretty similar odds for a casino, how they can, through the law of averages, that if you do enough trades with that type of probability, that you'll eventually come out ahead. And so they applied that law of averages with probability. They apply that situation again and again and again and again, and then through using large amounts of leverage, they were able to beat the market. Oh, and just in case you don't know what the law of averages is, it's basically a concept in probability that if you do an event enough times and you repeat it and repeat it, it'll eventually fall to its statistic norm. So for example, if you flip a coin 10 times, it could be any ratio of heads to tails. However, if you flip a coin 10,000 times, you'll find that it'll be almost exactly 50-50. So they had a 0.75% of an advantage over the market. And they exploited that advantage by using that trade and going it again and again and again, and then using leverage upon it as well. So between 1988 to 2018, he was averaging a 39.1% return after taxes. And when you consider that the market index ETF average is approximately 10%, or 9.8 to be precise, that is an incredible return. And yes, other billionaires have done this through investing all the money into a single business and then growing that single business and working on the business themselves. But you have to remember that Jim Simmons did this himself through the sole act of day trading. Across the 3 decades, he started up 3 hedge funds, and at one stage, he was the 24th richest person in the world. Furthermore, he was worth $55 billion. Holy cow. Now, across the decades, Jim had recruited a right-hand man. His name was Robert Mercer. And now, this is going to be a bit of a pretty interesting side story. But just to explain how powerful he became, I'm going to have to talk about politics. And I just want to make it very clear that I personally am politically neutral. Wimp. Tell them how you really feel. So imagine that you're having a friendly office debate about politics, and instead of having just your opinions though, you have billions of dollars at your disposal. So Jim Simmons, he comes from a scientific and mathematics background. So he saw it fit to donate to the Democrats because he saw them as a party that was more appropriate for dealing with subjects such as climate change and related ones. Now, Robert Mercer, his number 2 right-hand man, however, he was on the other side of the political spectrum, and he had ideologies that closely aligned with the Republican Party. And so you had the number 1 and the number 2 of this firm being massive donors to the 2016 election campaign. In fact, Robert Mercer was Trump's 3rd biggest political donor. You can very reasonably argue that Trump would not have won the 2016 election without Robert Mercer's help. And this is for 2 reasons. 1, he donated a lot of money, and that's obviously very useful for a political candidate. But 2, and this is quite often the overlooked one, is that Robert Mercer was actually a major owner of a data collection firm known as Cambridge Analytica. Wasn't that the company that got in trouble for breaching data privacy laws and then used that data to sell to political candidates to win elections, and was the subject of a Netflix documentary recently about their unethical behavior? Yes, that Cambridge Analytica. So, over time, this is obviously not going to be sustainable. Imagine that you have an office with people with extremely opposing political views, but all of them have billions of dollars at their disposal. So where this political debate was getting the most intense was Renaissance Technologies. The majority of the people that worked for Renaissance Technologies were like-minded with Jim Simmons. They supported the Democrat policies and they're more just against the Republican policies, or especially the Trump administration at the time. And they're getting very frustrated that a lot of the firm's profits were going towards supporting Trump's policies. And so this started a massive internal rift within the company, and the employees started trying to put more and more pressure for Jim Simmons himself to actually push Robert Mercer out. However, Jim Simmons, although his views were very opposed to Robert Mercer's, he had a very big mindset that what the team members do with their money on their personal time is their business and the firm should not interfere with that. And so this is much to the frustration of the other traders that are working for the firm. And so it got to the point where one of the traders actually leaked to the press about how much of Renaissance Technologies' profits and resources were supporting the Trump campaign. And so this caused a bit of an issue for Renaissance Technologies, because in the scientific and mathematical communities, there is an overwhelming overwhelming leaning towards supporting Democrats over Republicans. I know there are exceptions, and Robert Mercer is clearly one of them, but out of the mathematicians and traders at the firm at the time, there was very much a heavy Democratic leaning. And so, with this being leaked to the press, Renaissance Technologies now faced a new dilemma that Jim Simmons had to deal with. If he let Robert Mercer stay with the company and continue to support Trump's Republican campaigns for the future elections, he'd be faced in a situation where he might lose some of his best traders. So I thought that was an incredibly interesting story from the book The Man Who Solved the Market, which is basically the book about the story of Jim Simmons. How does knowing all of this apply to today, and how does this apply for both the modern world and also yourself? Well, since Jim Simmons actually did this and massively successful at this, there are hundreds of hedge funds that have basically copied the techniques that they're doing. And it is actually one of Elon Musk's biggest complaints about the world of mathematics now, that the best minds are being used to try and beat the market rather than advance humanity forward. And another thing to note is that with thousands of hedge funds attempting to do this, we're now entering into a phase that is basically referred to as an efficient markets theory. So what the efficient markets theory is that with all the information that is public, every share price, every crypto price, every commodity price is priced as how it should be. Now, what made Jim Simmons and his three hedge funds so successful was that in the 80s, 90s, and early 2000s, it was very far from being the efficient market. There was a lot of error and a lot of things were not priced correctly. And with that, they were able to apply mathematical models and then exploit those imperfections in the market. However, with numerous hedge funds throwing millions and in some cases billions of dollars at these market inefficiencies, you can now reasonably state that the markets are pretty much right on the efficient market theory. And with so many people trying to make money on the efficiencies, it's basically no room left to make money on that, which hence creates the perfectly efficient market. And it is for this exact reason that Jim Simmons is actually very big on keeping a very low profile with these three hedge funds. They're purposely keeping themselves small so they'll not attract the attention of regulators and they'll not attract the attention of copycats who then take away those market advantages. So when someone approaches you and offers you trading secrets to beat the market, you should just basically know that anyone that is legitimately beating the market is trying to keep themselves hidden and trying to keep as low a profile as humanly possible.